The experiment is over. The last desperate Hail Mary attempt to restore fiscal sanity to the American financial system has not just stalled, it has been systematically dismantled before our very eyes. For the past few months, the eyes of the financial world, from the high-frequency traders in New York to the central bankers in Zurich, were fixed on a singular, shimmering hope: the Department of Government Efficiency, or DOGE, led by Elon Musk. It was pitched to the American public as the ultimate solution, the shock therapy that would finally slash the ballooning federal budget, curb the runaway deficit, and save the US dollar from the mathematics of inevitability. We were promised a revolution. We were told that the days of $500 hammers and bridges to nowhere were ending. We were told that efficiency was coming, that the waste would end, and that the trajectory of the national debt, which just crossed the terrifying psychological threshold of $38 trillion, would finally be reversed. But yesterday, the news broke, quietly at first, buried under headlines about celebrity gossip and trivial sports scores, designed to be missed by the average citizen. The initiative has been effectively neutralized. The establishment fought back with a ferocity that surprised even the cynics. The bureaucracy proved to be not just resistant to change, but immune to it. The efficiency narrative has officially failed. The antibodies of the deep state attack the cure, and the patient remains terminal. With that failure, the only brake pedal on the American economy has been removed. The car is now careening downhill, the speedometer is climbing, and there is no way to stop. Most people do not understand the gravity of this moment. They think this is just another political squabble in Washington, another cycle of partisan bickering. They are wrong. This was the last stand for the conventional US dollar, as we have known it for the last 50 years. Without significant spending cuts, which are now politically dead, there is only one mathematical path left for the United States: financial repression and infinite money printing. To pay the interest on $38 trillion of debt without cutting spending, the Federal Reserve will be forced to print money on a scale that makes the 2020 pandemic stimulus look like a warm-up act. We are entering the phase of fiscal dominance, a terrifying economic state where the central bank loses control of inflation because it must prioritize saving the government from bankruptcy over saving the purchasing power of your wallet. While the mainstream media debates the political fallout, the smartest investor in history has already rendered his verdict. Warren Buffett is not waiting for a press conference to tell him what to do. He isn't waiting for the Federal Reserve minutes. He has looked at the failure of fiscal discipline, looked at the debt mountain that is growing by $1 trillion every 100 days, and made the most aggressive defensive move of his 94-year life. New filings reveal that Berkshire Hathaway is now sitting on a record-breaking cash fortress of $382 billion. Let that number sink in. That is not just dry powder waiting for a deal. That is more cash than the market cap of Disney, Pfizer, or Coca-Cola. That is a vote of no confidence in the current market valuation and the future purchasing power of the currency. He is selling American icons like Apple and Bank of America at a frantic pace, dumping shares into the rally. He is fleeing the financial economy of stocks and bonds and retreating into the tangible economy of energy and short-term liquidity. Buffett knows that the soft landing narrative is a lie sold to retail investors to keep them holding the bag. He knows that when the last attempt fails, the only thing left is the great reset of asset prices. But here is the paradox that confuses almost everyone, the riddle that you must solve to survive. If Buffett believes the dollar is doomed to inflate, why is he holding $382 billion in cash? Why isn't he buying everything in sight? Why isn't he panic buying gold or Bitcoin? The answer lies in a specific, counterintuitive playbook that Buffett mastered during the inflationary crises of the 1970s. He knows something you don't. He knows that in the early stages of a currency crisis, cash is king because it gives you optionality. He knows that the death of the dollar won't happen in a straight line. It will be a volatile, violent process of crashes and spikes, where liquidity disappears right when you need it most. In this deep dive video, we are not just going to analyze the problem. We are going to open the history books and the Berkshire Hathaway portfolio to reveal the 5 rules of survival that Warren Buffett is using right now to prepare for the post-DOGE era. These are the rules that separate the victims of inflation from the architects of generational wealth. To understand the playbook Buffett is using today, we have to travel back in time. We have to go back to the last time the US government lost control of its checkbook and faced a debt crisis that threatened the very existence of the dollar. We have to go back to a specific Sunday evening, August 15, 1971. The setting was grave. President Richard Nixon interrupted popular television shows like Bonanza to address the nation. The economy was overheating. Inflation was rising. Foreign nations, particularly France, were demanding to exchange their paper dollars for physical gold bars from the U.S. reserves. The U.S. gold supply was draining away. The government was cornered. Nixon looked into the camera and announced that he was temporarily suspending the convertibility of the U.S. dollar into gold. He told the American people it was to stop speculators. He told them it would stabilize the dollar. He told them their money was safe. It was a lie. It wasn't temporary. It was permanent. It was the default of the United States on its obligations. It was the moment the hard dollar died and the fiat dollar was born, a currency backed by nothing but faith and military power. Just like today, with the failure of the efficiency measures, the government in the late 60s had spent too much. They had pursued the guns and butter policy, fighting the expensive Vietnam War and building the massive Great Society social programs simultaneously. They ran massive deficits. The world lost trust. The fix was to break the system and print money. What happened next is the narrative echo we are living through right now. For the next decade, the 1970s, the US economy was ravaged by stagflation, stagnant growth combined with high inflation. The stock market went nowhere in nominal terms for nearly 15 years and lost 70% of its value in real, inflation-adjusted terms. Bonds, which were once considered safe investments for widows and orphans, were dubbed certificates of confiscation because their fixed interest payments bought less and less every year. But amidst this carnage, a young Warren Buffett made his fortune. While everyone else was losing money trying to play by the old rules, buying bonds, holding growth stocks, trusting the government, Buffett changed the game. He realized that in an inflationary regime where the government has abandoned fiscal discipline, you cannot own promises. You must own pricing power. He bought See's Candies. He bought newspapers like the Washington Post. He bought businesses that could raise prices on their customers without losing volume. He realized that if inflation is 10%, a business that can raise prices by 12% is actually growing. He essentially bought his own personal inflation hedges. He didn't hedge with gold bars in a vault. He hedged with productive monopolies that churned out cash flow. Today, the failure of the DOGE initiative is our Nixon shock moment. It is the admission that the government cannot and will not balance its books. The debt of $38 trillion is the new Vietnam War, an unwinnable financial conflict that drains the Treasury every single day with interest payments that now exceed the entire defense budget. The signal Buffett is sending by accumulating $382 billion in 2025 is identical to the signal he sent in the 1970s. He is clearing the decks. He is realizing that the financial assets, the stocks trading at 30 times earnings, the long-term bonds paying 4%, are promises that the government cannot keep in real terms. He is preparing to deploy that massive pile of cash into the only assets that survive a currency debasement. Most people think Buffett is betting on a crash. He is. But he is also betting on what comes after the crash, the inflationary supercycle, where assets are repriced in a worthless currency, and he has a specific set of rules to navigate it. Before we get to the rules, we must briefly deconstruct why the efficiency attempt failed, because this mechanism explains why your money is in danger. It wasn't just incompetence. It wasn't just politics. It was mathematics. The US financial system, and by extension the global financial system, is built on the foundation of treasury bonds. These bonds are considered risk-free collateral. They are the plumbing of the entire banking system. Every bank, every pension fund, every insurance company holds them as their primary reserve asset. The value of these bonds depends entirely on the belief that the US government can pay its debts. Now, consider the proposal from Elon Musk and the DOGE Commission. They wanted to cut $2 trillion from the federal budget. On paper, this makes sense. Stop spending money you don't have. But in reality, that $2 trillion represents the revenue stream for thousands of companies and millions of employees. If they had succeeded in cutting $2 trillion, it would have caused a massive deflationary shock. GDP would have collapsed. tax revenues would have plummeted because unemployed people don't pay income tax and bankrupt companies don't pay corporate tax. Paradoxically, the debt-to-GDP ratio, the most important metric for sovereign creditworthiness, would have spiked. Why? Because the denominator, GDP, would have shrunk faster than the numerator, debt. A shrinking economy makes the debt burden feel heavier, not lighter. This would have caused a panic in the bond market. The system fought back because the system needs the waste. The waste is the liquidity. The government spending is the revenue for the defense contractors like Lockheed Martin, the healthcare giants like United Health, and the state governments that depend on federal grants. If you cut the spending, you crash the stock market and the banking system instantly. So the establishment chose the alternative. They rejected the pain of austerity. They chose fiscal dominance. This is a technical term you need to know. Fiscal dominance happens when the national debt is so high that the central bank, the Fed, can no longer set interest rates to fight inflation. Instead, it must set interest rates to keep the government solvent. It must print money to buy the government's debt, because no foreign nation, not China, not Japan, not Saudi Arabia, is willing to buy it anymore at these levels. With the efficiency plan dead, fiscal dominance is now the law of the land. The Fed has no choice but to monetize the debt. This means the supply of dollars will expand to infinity to cover the $38 trillion hole. It means inflation is not a bug, it is a feature. It is the only way out. This is why Buffett is sitting on cash. He knows that in a regime of fiscal dominance, the price of everything becomes volatile. He knows that the safe 401k portfolio of index funds is a trap because it relies on a stable dollar and low inflation. When the dollar loses its anchor, the index funds become boats in a hurricane. The last attempt to return to normal economics has died. We are now in the era of managed currency debasement, and to survive it, you need the Buffett playbook. Now we pivot to the core of this video. We are not just going to list generic advice like save money or cut coupons. We are going to break down the 5 rules of survival that Warren Buffett is applying right now to his own $1 trillion empire. This is the blueprint for the middle class to survive the death of the efficient dollar. Rule number 1, the cash paradox. Liquidity is not an investment, it is a weapon. This is the rule that confuses people the most. If the dollar is dying, why does Buffett have $382 billion in cash? Shouldn't he dump it for assets immediately? The answer is optionality. In the early stages of a debt crisis, liquidity dries up. When the market realizes the debt is unsustainable, credit freezes. Banks stop lending. Stock prices crash not because the companies are bad, but because everyone is forced to sell to raise cash. Buffett holds cash not because he likes the dollar, but because he loves what the dollar can buy during a panic. He views cash as a call option on every asset class with no expiration date. The simulation. Imagine it is mid-2026. The inflation news is bad. The bond market riots, sending interest rates to 8%. Stocks crash 40%. Your neighbor, who is fully invested in growth stocks and AI tech, receives a margin call. Or maybe he loses his job. He is forced to sell his house to cover his debts. He has to sell his $500,000 house for $300,000 because nobody has a mortgage approval. You, following rule number 1, have a large cash pile in short-term T-bills. You step in, you buy the house for $300,000. You just made an instant profit on the buy. You acquired a real asset for pennies on the dollar because you had liquidity when nobody else did. Buffett is holding cash to be the buyer of last resort. He knows that cash loses 5% or 10% to inflation a year. But that is a small price to pay for the ability to buy assets at a 50% discount when the crash happens. Your action. Do not be fully invested. Keep a war chest of liquid cash in Treasury money market funds or short-term T-bills that is separate from your emergency fund. This is your ammunition for the crash. Rule number 2, the pricing power moat, your personal inflation shield. In an inflationary depression, stagflation, costs go up for everyone. Raw materials cost more, labor costs more, energy costs more. Companies that cannot raise prices die because their margins get crushed. Companies that can raise prices survive and thrive. Buffett is actively selling companies that operate in highly competitive markets, like generic consumer electronics or cars, where consumers are price sensitive. He is holding companies with pricing power. He loves Apple because people will pay $200 for an iPhone even if milk costs $10. It is an addiction, a necessity. He loves American Express because they take a percentage of every transaction. If prices go up due to inflation, their revenue goes up automatically without them doing anything. It is an implicit inflation hedge. The simulation. Imagine you own stock in a car company like Ford or GM. Inflation hits. Steel costs go up. Labor unions demand higher wages. The cost to build a car rises by 20%. But consumers are broke because of the economy, so the car company cannot raise prices. Their profit margin goes to zero. Their stock crashes. Now imagine you own a utility company or a railroad, like Buffett's BNSF. Inflation hits. Diesel costs go up. But the railroad is the only way to move grain and coal across the country. They raise their shipping rates by 15%. The farmers and power plants have to pay it. The railroad maintains its profit margin in real terms. Your action: audit your portfolio. Do you own companies that have to compete on price? Sell them. Buy companies that provide essentials or addictive luxuries where the customer has no choice but to pay. Utilities, healthcare, essential consumer goods. Rule number 3. Hard assets over paper promises. The real economy. This is the biggest shift in Buffett's portfolio in the last 5 years. He is moving from paper, banks, to rock, energy. He is aggressively buying Occidental Petroleum and Chevron. Why? Because oil is a hard asset. You cannot print oil. You cannot devalue oil by legislative act. It takes geology, engineering, and time to produce energy. If the dollar collapses, the price of oil in dollars goes to the moon. The failure of DOG means the government will print money. Printed money chases real goods. The most essential real good is energy. The simulation. The dollar loses 20% of its value in 2026 due to money printing. Your bond portfolio, which pays 4% interest, effectively loses 16% of its purchasing power. You are poorer. But your energy stocks? Oil jumps from $75 to $120 a barrel to adjust for the weaker dollar. Your energy stocks double in price. You have preserved your wealth. You have transferred your purchasing power from a dying currency to a living commodity. Your action: you need exposure to the physical world. Energy stocks, commodities, ETFs, agricultural land, or real estate, if the debt is fixed. Do not rely solely on tech stocks that trade on future earnings. Future earnings are worthless if the currency used to measure them is broken. Rule number 4. The debt guillotine. Avoid leverage like the plague. This is Buffett's most strict rule. Never risk what you have and need for what you don't have and don't need. In a volatile period where the government is manipulating the currency, interest rates can spike overnight. If you have variable rate debt, credit cards, HELOCs, margin loans, you are walking on a tightrope without a net. When the DOGE cuts failed, the bond market realized the US government is a credit risk. This realization pushes rates up, regardless of what the Fed wants. The simulation. You have a HELOC on your house with a variable rate. You use it to invest or renovate your kitchen. Suddenly, due to the debt crisis, rates jump from 8% to 14%. Your monthly payment doubles. At the same time, the economy slows down and your commission check shrinks. You are squeezed. You are forced to sell your assets at the bottom to pay the bank. Buffett avoids this by having zero net debt and massive cash. He never faces a margin call. He is the one making the margin call. Your action: pay off all variable debt immediately. If you have a fixed 3% mortgage, keep it. That is an asset in inflation because you are paying back the bank with cheaper dollars. But kill every other form of debt. You want to be the lender, not the borrower, in a high-rate world. Rule number 5. The psychology of the crowd. Contrarianism is survival. The final rule is psychological. The failure of the efficiency movement will cause mood swings in the market. One day the crowd will scream hyperinflation and panic buy gold. The next day they will scream recession and panic buy bonds. Buffett ignores the news cycle. He ignores the Fed speak. He looks at valuations. When the crowd was buying tech stocks in 2024-2025, pushing Nvidia and others to the moon, Buffett was selling. When the crowd eventually panics in 2026 because the last attempt failed and the realization of the debt crisis sets in, Buffett will be buying. The simulation. It is 2026. The news says, dollar in free fall. Your friends are panic selling their stocks to buy crypto or canned food. The market PE ratio drops to 12. Great companies are trading for peanuts. The crowd is terrified. You, following rule number 5, are calm. You have your cash. Rule 1. You have your list of essential businesses. Rule 2. You step in and buy the highest quality assets in the world from people who are selling them out of fear. Your action. Stop watching the daily price action. Create a shopping list of assets you want to own, productive land, blue-chip companies, and set the price you want to pay. Wait for the chaos to bring the price to you. There is one more layer to this, a plot twist that makes Buffett's move to energy even more genius. With the failure of the DOG and the explosion of debt to $38 trillion, the government will become desperate. History shows that desperate governments turn to capital controls and price controls. We are heading towards a form of shadow nationalization. The government won't officially seize companies like they do in communist regimes, but they will regulate them so heavily through price controls, windfall profit taxes, and production mandates that they effectively control them. However, the one sector the government cannot crush too hard is energy, because they need it for national security and to keep the lights on. They might tax it, but they will ensure it remains profitable enough to produce. Buffett knows that in a command economy, which is what we are becoming after the failure of free market efficiency, you want to own the assets that the government needs. They need the railroad to move military equipment and food. They need the oil to fuel the Navy and the economy. By owning BNSF and Occidental, Buffett has made himself a partner to the state, not a victim of it. He has bought political insurance. Let's look deeper at what he sold. He sold Bank of America. He sold US. Bancorp. Why? Because in the post-DOG world, banks are the victims. The government will force banks to buy the US treasuries that nobody else wants. This is called financial repression. The government will stuff the bank's balance sheets with low-yielding debt to fund the deficit. This destroys the profitability of banks. It turns them into regulated utilities that exist to fund the state, not to make money for shareholders. Buffett sees this. He is getting his money out of the middleman, the banks, and putting it directly into the source, treasuries, or the product, energy. He is cutting out the dying financial sector. The blast zone for 2026 is the banking sector and the consumer discretionary sector. If the efficiency plan failed, the consumer will be crushed by inflation. Avoid companies that sell things people don't need. Now, we summarize the survival plan based on the failure of the last attempt. The title says, "It failed," so here is how you succeed. Action 1. Build the cash fortress. Stop trying to maximize returns right now. Maximize safety and liquidity. Aim for 20–30% of your portfolio in short-term treasuries or high-yield cash. This is your dry powder for the crash. Action 2. Rotate into real assets. If you are heavy in tech ETFs, consider rotating a portion into energy ETFs, like XLE, or infrastructure funds. You need things that hurt when you drop them on your foot. Action 3. Secure your income stream. The failure of efficiency means the economy will become more chaotic. Ensure your primary income source is robust. If your job depends on cheap interest rates, like mortgage brokering or car sales, have a plan B. Action 4. Prepare for capital controls. As the debt crisis worsens, the government may try to stop money from leaving the country or moving into crypto. Have some diversity in where you hold your wealth. Physical gold is a way to hold wealth outside the digital control grid. The final verdict on the failure of the DOGE and the $38 trillion debt wall is a call to reality. The fantasy that we could simply cut the waste and fix the country without pain has died. The math was always impossible. We are now on the path of the inflationary reset. The dollar will be sacrificed to save the debt. The standard of living will fall for those who hold dollars, and it will rise for those who hold productive assets. Warren Buffett has already placed his bets. He has sold the banks. He has bought the oil. He has hoarded the cash. He is ready for the storm. You must do the same. Do not wait for the government to announce a solution. Their solutions are the problem. You need to position yourself now. Get liquid. Get real. Get independent. Be like Buffett. Ignore the political noise. Look at the cold hard math. and move your chips to the winning side of the board before the game resets. The attempt to save the dollar failed. The attempt to save your fortune begins now. I am immensely grateful to you for staying until the end of this critical warning. This information is the difference between being a victim of history and a student of it. If you found this breakdown valuable, make sure to like and subscribe so we can keep bringing you the truth about the financial system that the brochures leave out. Stay vigilant, stay prepared, and we will see you in the next video.